All right, welcome to the live stream. Welcome to all of you. Be the boss of your money is a show. It's about helping you take control of your money. You're faced with you're faced with decisions all day long about money, how to spend it, how to save it, and you can turn off the commercials, stop looking at social media, which could be good, but not too good because then you wouldn't see my live stream and learn all this awesome stuff. But we talk about money here, but we also talk about investing an awful lot because investing has a lot to do with money. It's one thing to invest and to take advantage of retirement plan contributions and investing for the long term. But what do you invest in? Um, should you be making, you know, excuse me, what do you invest in? Should you be making changes to your portfolio every time you think the economy is going to have a change of direction, even stronger, either stronger or weaker, or based on politics? Well, there are lots of things to change, and sometimes certain sectors go up an awful lot, and it's time to rebalance into something else. And if you were to do that, for example, technology is way up. We all know that this is common knowledge that the tech sector has lifted the Nasdaq and the S&P to new record highs consistently. So since that, technology is the biggest, uh, is the most highly represented sector now in the S&P 500. So it could make sense for some people to rebalance and put that money into something else. But if there's a change in the economy, where would that money go? So we're going to talk about what kind of stocks could do potentially well relative or compared to stocks that could do well when interest rates go up and the economy strengthens. By the way, you can't invest directly into an index, but you could invest into a security that tracks or mimics the index. So let's roll a quick intro. And here we go. Stick around. This will be very informative. All right. Thank you for joining me. I'm Mitch Goldberg. I'm with Client First Strategy. We are a wealth management firm. We like to say plan, invest, repeat. So let's talk about a couple of things. Major averages were off a little. Dow, S&P, NASDAQ. I mean, they were off, a fraction of a percent. It was a very quiet day, which I think is a welcome relief compared to, considering all the news that we've had the last couple of weeks, especially the last 2 weekends. An assassination, then President Biden dropping out of the presidential race, uploading or upending, I should say, a lot of things in politics. So we have a lot going on, and I always like to give you a message in the market. Stocks could be right short term, stocks could be right long term, but I'm looking for trends. And what I've been saying for a long time is if you want to know how the stock market's doing, you have to really look at the super mega cap, large cap stocks. And we talk about those all the time. It's Tesla, it's Facebook, Alphabet. Facebook is called Meta now. That's the official name. Alphabet is the official name for Google. NVIDIA, Microsoft, Netflix. You know the names you talk about all the time. But if you want to know how the economy is doing, there are other areas to look at. And just because, and we reiterate this every cycle. I've been doing this now for 34 years. Oh my goodness, it just sounds so weird when I say how long I've been doing this. A weakening / slowing economy, even a recessionary economy, meaning the economy is not just slowing to a very slow rate of growth, but it's actually shrinking. These are not necessarily bad for the stock market. I think inflation or inflation expectations are a much bigger deal. Now, it makes sense to expect inflation to pick up when the economy does better, and it makes sense for inflation to go down, or at least the rate of inflation growth to go down when the market slows. And when the market slows, it means that companies that are sensitive to the economy, like industrial type companies or materials, it often means that maybe they, they won't have as much economic strength in their sales to keep their earnings going higher. But there are companies whose earnings and revenues might not necessarily go up in a slowing economy, but they're at least considered staple or stable. That brings me to consumer staples. Okay, but so they're more stable. What am I talking about staples for? And I'm talking about stability. In other words, companies that sell consumer staples. I don't mean like the staples that you get like in a stapler. I mean consumer staples are companies that make or sell food, companies that make toothpaste, toilet paper. These are the companies whose earnings are expected to maybe not grow so much if the economy is stronger, but their earnings shouldn't shrink so much if the economy is weaker because they're steady. People still have to spend money on food, toothpaste, and toilet paper, no matter what the economy does. So if the economy slows down and if you expect earnings to either decelerate in growth or actually go down in certain companies, industrial companies, then the stocks of those companies become less attractive. They would go down typically, partially because the earnings are going down, but also because investors decide they don't want to hold on to as much of those stocks, so they sell. And where do they put that money? They go into sectors like consumer staples, and I'll show you the stocks in this particular sector. That is a move. And money could also go into companies that pay high dividends, like utilities. Now, this isn't always going to work out, and it's still going to be a jaggedy, very up and down path. And if the economy does slow down too much and does go into a recession, it is possible for all the stocks from industrials, economically sensitive stocks to consumer staples, which are not so economically sensitive. They could all, or at least not so sensitive to the vagaries of the economy. They could all go down. But maybe consumer staples and utilities go down less. Industrials and materials and consumer discretion could go down more. By the way, the difference between consumer discretionary stocks and consumer staples stocks is this. Consumer discretionary make things you want. Michael Kors, Kate Spade, those are consumer discretionary items. Forgot the name of the company that makes them. It evades me at the moment. It's a company, darn. Michael Kors is bought out by this company. Okay, it's not important. And then there are consumer staples companies which make things that you need, like Procter and Gamble. Okay, they make things that you will need. Heinz, for example, food companies. Think of a big publicly traded food company, maybe Mondelez, right? So these are the kinds of companies that could change hands. You think about utilities, because no matter what the economy does, electric usage typically rises and falls more with population growth than anything else. Now, we are an electrified nation with more people charging their cars and more people using computers, potentially expected for artificial intelligence applications. Usage of electricity is expected to go up, not down. All right. So we want to know the different kinds of stocks in terms of economically sensitive companies, interest rate sensitive companies. And having said that, banks are like an in-between area. Banks could do better if interest rates go lower, because it means that the yield curve could become a little more inverted because the Federal Reserve is lowering short-term rates, and the yield curve, which is inverted, could become uninverted, normalized, right? Normalized is the word. But it also means that if the economy becomes too weak, you could start to see companies and consumers default on debt like business loans, industrial loans, and mortgages, that sort of thing. So banks are kind of in this in between land. They could do better or worse when interest rates and inflation change. So it all bears watching. Ultimately, you want to be in companies that are growing. That is the ultimate deal, or companies that go from a company not growing, like a value company, to a growth company. The worst thing is when a growth company that is richly valued, like a good growth company would be, when they stop having the strong growth and they become slow growth companies, those kinds of stocks typically get crushed. And those are the worst ones to have. And they could take forever if they ever do recover. Okay, so the symbol for, let's look at some of the consumer staple stocks. I'll put you on this. Consumer staples, okay? Um, Costco is tough to say if it's consumer staples. They sell a lot of things. Same with Walmart. But B&G Foods, Coke, Beyond Meat. I'm not saying all of these stocks would do well. Beyond Meat has been a disaster of a stock. Kraft Heinz has not been a great performer for well over 10 years. Clorox, they peaked out during the pandemic when everybody wanted their cleaning products. They haven't since done anything great. But if you see these lines here, Walgreens, Alliance, that's a shame. That's an $11 stock. But CVS is down a lot from its former high. Hershey's is down a lot. These stocks have not done so great, but with inflation slowing and interest rates going down, and that means the economy could be weakening. These companies' earnings could start to look more attractive relative to the earnings power of industrial type or cyclical companies. Also, consumer staples often are dividend payers. So when interest rates are going down, a company's stock dividend could be worth more money relative to other investments that either pay dividends or interest. So utilities, consumer staples, those often do well in a period of rates that are falling. Banks could do better. It depends on if the economy is slowing too quickly, banks could suffer. Uh, Everything else, I think, could suffer in terms of higher interest rates because that's the history of the stock market. So if you're contemplating rebalancing, let's talk about tech. Tech could do better when interest rates go lower because companies that are richly valued or companies that are trading based on what they're going to earn in a couple of years, their earnings are worth more when interest rates are low, the way the future dollars are discounted to net present value. However, tech stocks are also up an awful lot, and investors still want to look like they want to rotate into other things that could do better if interest rates come down. So there is a lot to hash out, and we're just getting into political season, which really starts after Labor Day, because then it's that all-out sprint for debates and the elections coming up. So we have a lot of things to watch out. It's going to be extraordinarily interesting. We'll see how it plays out. But if you're looking to make a rebalancing move in your portfolio, stocks that do better when rates go lower and inflation goes down and the economy weakens could have the upper hand. This is all subject to if, and ultimately the economy goes up and goes down, does well. Sometimes it does poorly, sometimes. But the trend is overall the economy does grow, corporate earnings do grow, and overall, I think long term, the best strategy is still to have a diversified portfolio so that you could potentially capitalize on both outcomes, either a stronger economy or a weaker economy. Diversification is a strategy that we use to mitigate risk, but it doesn't necessarily protect your portfolio from going down in a generally down market. Thanks so much for watching, and I'll see you all tomorrow.